Stock started the day on the downslope, but then rallied after the FOMC meeting once we kind of figured out what was going on and pretty much priced in over the last month what was going to be announced today, and then the markets rebounded. So we're going to break down, whether this rebound is the beginning of a new trend, whether this rebound was still an oversold technical bounce. There's a big difference still between the S&P and the Russell 2000, so we're going to look at that difference there. We're also going to take a look at a stock that broke out to the upside quite nicely. But before we do, I just wanted to give a shout out to my son's 8th grade basketball team that I coach. Apparently they watch these videos maybe too much in their math class on Tuesdays and Thursdays. So I just wanted to give them a shout out and let them know that I appreciate them tuning in every week. So let's go ahead and get started. Today is Wednesday, December the 15th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. Big move today. So we were trading, we kind of flirted with the 23% retracement level, getting back below it yesterday. And we're below it today going into that Fed meeting. And then, woof, big time move to the upside coming out of the FOMC. We'll talk more about that here later in the video. But from a technical perspective, right back to dark green shading and the green line, just like that, right? You had a brief drop on the near-term line into bearish territory. You're right back in the bullish territory now, with it just getting right there above the 60th percentile. Very strong momentum move up above the 90th percentile. Obviously back above the 23% line, so very, very strong move and double the range. We'll talk more about that here. Just about double the range, so very strong rally. It actually erased the one red tag we had up here. All these tags have been, pretty good dark green, but we had one red tag on the monthly chart. That's gone. So back to a bullish posture. The green line is already in bullish territory anyway, so it's light pink shading the yellow line, as you can see, is a bullish signal that actually played out this go around. If you take a look at some of the other major indexes and their charts, here's the Dow Jones Industrial Average. Again, intermediate line staying and turning higher again, already in the bullish territory, 0.75% above the moving average, back slightly above the 23% retracement level. Very strong move, very strong daily range relative to the average. There's your NDX, again, very same thing, back above the 23% retracement level of this intermediate decline we've been on. The intermediate line still pointed lower because we were a little bit more bearish. We had more of a bearish drop yesterday than what we saw, like say in the S&P, but erased that today, filled in that gap, and then some. Again, the momentum line getting to a very high level, but not the near-term line, still just in bullish territory. So we'll see how we respond to that tomorrow. And then finally, your Russell 2000. There's your Russell. It's been the most bearish. Obviously, it's not back above its 23% retracement. So all those other indexes are all back above this line. The Russell is not only not back above that line, but it's not even back above the 78% line. It just barely got back above the 100% line retracement level. So you got a lot more work to do on the Russell 2000 when it barely finished without a cluster yesterday. We actually did have a cluster today, again, going into the FOMC meeting. And then obviously that was erased with the close above yesterday's high point there. Very strong rally, long lower shadow as well. And again, unlike all the other averages, we are not above the moving average. We're still about 5% below it. So we still got a lot of work to do there. Not quite out of the woods on the Russell 2000, which means we're not quite out of the woods from a broad standpoint either on all these major indexes. Let's take a look at the long-term chart. The S&P's chart has got a bullish candle, had a transition there, back to a bullish candle on the S&P. The Russell 2000, even with today's rally, still no upper shadow. So we're still got a bearish candle, and we're still kind of flirting on the closing basis with that 40-week exponential moving average. So again, like falling PPO, we don't have a green arrow, but we still have a negative differential. So, so as great as it looks on all the other indexes, it doesn't look still pretty bearish here on the Russell 2000. Let's take a look at the Three green arrows. We're back to three green arrows on the S&P, so you got the green shading. You got two and excuse me, almost a third green arrow on the what is that, negative 0.1. So almost three green arrows on the Qs. We did get three green arrows on the diamonds. So, and you can see the histogram, which was turning lower on the diamonds, and the SPY turned back up with a green bar there. Not the case. Still three red arrows for the Russell. So it's like, again, you can see that it's just two different markets here, with the Russell being completely different than what we're seeing on the S&P. The S&P back above its 30-day moving average. The 8-day is back above the 30-day moving average. The 17-day is probably close. The 8's above the 17. We're back to bullish divergence mode. We got back above the 17-day moving average there. Very similar on the diamonds. Very similar on the Qs. Again, back above that 17-day moving average. So, potential for bullish divergence here. Again, not the same for the IWM. So it's not only not back above the 17, it's not even back above the 8. And it's still got a lot of resistance, and it's easily below the 200-day moving average. So at the very best, we're going to have a bearish convergence. So not a bullish divergence, but a bearish convergence here on the Russell. You did get a good amount of volume there. You can see the stochastics is still in bearish territory, and so is its moving average as well. So you can kind of get an idea of how things are. If we take a look at some of these other oscillating charts, let's look at the RSI. So SPX is still in the upper half of the chart. It flirted with 50 and flirted with 0, but maintained kind of relatively bullish levels. The Russell, on the other hand, is not bearish. It's not below 40 and 50, but it's not back above the midpoint of the charts yet either. So big difference there on the Russell 2000. Your NASDAQ is back above, just barely, back above 50 and back above 0. So it's just kind of getting going again to the other side. The directional movement index, you're between 20 and 25, so you're not really getting a trending move in either direction on SPY. Same thing with the diamonds, very non-directional move. Same thing with the Qs, very non-directional move. Not the same thing with IWM. That's a very directional move. We are well below 20. We are well above 25. We're actually above 30. So we're actually still in bearish breakout mode on the Russell 2000. Finally, looking at the Ichimoku cloud, you can see a noisy move on SPY. Diamonds is also a noisy level, so below, not above, not showing any trending signs, below 50, especially up there. Excuse me. Very noisy levels too, but we were almost bearish, right? So we were starting a weak bearish trend on the Qs, getting back below that green line, and the green already being below the blue line, but still above the cloud. Again, IWM, different story. We're not below 5, but we're at minus 4.92. No, we're not below minus 5, sorry, but we are close. We're not above. We are above 80 still, so 83. We're still below the green line. We're still well below the cloud. So, and the red line still well below the price from 26 days ago. So we're easily still in a bearish trend on the Russell. You can see the Russell. In fact, the green line is down at 0. So that typically marks lows for an intermediate pullback on the green line. The problem though is that the red line spiked up. We got a new 4-week low on that. So the SPY, again, same thing. We got the bearish signal, and the green line, when it hits 0, usually tests the low, or sets the low. It looks like we've already set the low on the SPY, and Q is kind of doing the same thing. It looks like we may have already set the low before that even gets down to 0, like it did over here. That's usually when you set the low point, and then again, that means that the 4-week high is on the very far end of the chart. On the left, on this chart, it's on the very far end of the chart. So SPY, it's close, it's not quite there, and you can see IWM, it is over there. So the green is at 0, and the red line is at 100, because the low is on today's. And we did jump up. We did not close above yesterday's high. Boy, we came really close. In fact, I guess you could probably say that we did, just barely. but we're kind of at yesterday's high point, at that point of control. So really important tomorrow that you break through that, especially getting up here in the upper half of the chart and start filling in that gap there. Really important that you break through that and get going. Otherwise, not so good, right? At least on the SPY, we did fill in. We did close above yesterday's high. We did not close above last week's high, so that's going to be the resistance for our SPY for this next couple of days. Same thing on the Qs. We got back in the upper half of the chart, but we did hit the point of control. The last week's high is still up there. So let's see how we do. Let's see how we fill in, whether or not with this resistance hold. You expect resistance to hold until it doesn't. So, I kind of expect that we probably got too much of a bullish move today, and we won't be able to sustain it. But that remains to be seen, of course, by the time all is said and done. Let's take a look now at the volatility. See, today's I showed you the range was 10 points, and the volume was 116 million. Let's put those numbers in context. So 10 points is well off the ATR chart, well above the average. 116 million is also well off the volume chart for the 52-week average. So that volume and that range, again, that's, I've told you before, when you are in intermediate declines, you tend to get your biggest bullish days, and with such extreme volume, such extreme range, especially when we didn't come off of such an extreme volume and range, makes you wonder about. Those are bearish levels. Volume, those bring those averages up, and when those averages go up, trading range and volumes, when those averages go up, that's bearish, right? It's not bullish. And so it makes you wonder just a little bit about whether or not this was a breakout move, or whether it just was still a bounce back move from the bearishness that we've had, and not yet still, to where the historical volatility is getting up above implied volatility, which would signal the end. It can signal the end of these, or in the beginnings of these bullish runs, and the ends of the bearish runs when you get that implied volatility dipping below the historical volatility. Speaking of implied volatility, that's what the VIX measures, of course. And you can see it did drop down that below 20, and we dropped into pretty bearish levels here for volatility, right? So bullish levels for the stock market, being down below the 85th percentile. So not quite extremely oversold, but pretty close, getting to 80. You wouldn't expect that we would already be extremely oversold on a volatility level, but it just means that the VIX has dropped, but the back month is not dropping, right? And so that means people are still concerned about longer downside moves. Otherwise, that back month would drop too. And then when you look at the skew index, see if it's been updated here. Yep, it has been updated today. So yesterday's skew really dropped as the market's kind of like, okay, we're getting the tail risk. Today we're back up above 140. So we are below the average. We're not above 150. But there's still some demand. You can see 140 is still relatively high. Getting above 145, especially getting above 150, kind of shows that the market is pricing in. The options market is pricing in a 2 standard deviation event. But when you get up to 140, 145, you're kind of still in between 1 and 2 standard deviation. So, in terms of pricing that in. So the markets, again, for some perspective on just how high that is, let me zoom out so you can see there. So there's where we're at, and I'll go back to the left, and you can see those pretty high levels, right? The market is, still concerned about the tail risk, so we're not quite out of the woods there. You can even see the gamma exposure updated for today. Again, not as high as we've seen, but again, for some perspective on how high that is, there's today's, look over to the left. It's still a high level, so there's still a lot of call buying going on today. A lot of gamma exposure. Again, not relative to what we've seen in the past year, but would be very high compared to, say, the gamma exposure spike that we had going into 2018, right? Or the gamma, even is higher than the gamma exposure spike that we had going into COVID. And those sparked some very rapid sell-offs when that exposure was unwound, right? So it's interesting to see that volatility, like short-term volatility, has really dropped, and I think a lot of that has to do with like the Fed FOMC meeting was highly anticipated, and now it's gone. So now the market's gonna be either okay, we've got this behind us, let's march forward to the upside, or okay, that was the big event risk. Now, let's start to digest the risk that is still being priced in from the tail risk that's still being priced in. Is that still out there? And will that start to come down? Will the demand for that start to come down as we go into the holiday season? So my expectations are that considering the range and the volume today is probably a little too extreme to be sustained to the upside. So I think we'll probably get some kind of inside day tomorrow. Where we close on that inside day and how we close will dictate how bullish or bearish we are going into next week. If we stay at the upper end of today's range, which I don't expect, but I think that's obviously there's a chance that can happen. I think it's a lower probability scenario. But if we stay up towards the high end of today's range, then we'll probably have a good bullish expectation going in. If, however, we kind of gap down and stay towards the lower end of today's range, then with an inside day, of course, then how we finish Friday, and then our expectations for next week will be more on the downside. So it would kind of not confirm this bounce, this breakout. Obviously, we'd be getting back below that 23% line. I think that's your higher probability, again, because of how extreme the volume and range was today. And again, those kind of numbers are more typical of a bullish day and a bearish trend rather than a bullish breakout, right, move that would lead to more bullishness going forward. So what do you think? Do you agree with that? Do you disagree? Now let me know in the comment section below, especially if you disagree, as to whether as to why you're either a lot more bullish I am or why you're a lot more bearish than I am, with what you're looking at to kind of help support that idea. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here on the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube that notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon that tells us two things. You liked our video today and you want us to do another video again tomorrow. Quick way to give us feedback if you like our stuff. Of course, if you don't like our stuff, you don't have to click on anything. You don't even have to watch if you don't want to. Also, comment down there. What did you get out of the videos today? What stood out to you? What questions or comments do you have? Post those in the comment section below. Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. Alright, if you're watching us here on our blog, check out some of these other things on the page, including this icon. Click on this icon right here that takes you to our Market Outlook live page. Every Monday, Wednesday, and Friday, I do a Market Outlook live video at 3:30 Eastern Time. It's right here. This is where you watch it. You can see all the old archives here. I review all the old trades that we've done in previous Market Outlook videos. I already put on today's trade idea before the market closed today. I did that here live, so make sure you check that out. Also, if you come down, you can see our upcoming classes that we have coming up. Click on the View More. It takes you to our calendar. You can see all of our upcoming classes as well as 3 years worth of recordings that are posted there. If you come down to the bottom, click that heart. It opens up this new tab. Hit that like button. Also click on this thumbs up icon. It opens up this tab and click that like button. Again, the more you do that, it helps us get out content out to more of our followers. It also helps you by making sure that you see all of our content, because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here. Alright, now let's take a look at what's driving this price action today. So we'll just go down to a comparison chart here. And let's just go to today so we can see kind of like the post FOMC reaction was to today's move. Let's go to a 2-minute chart. So you can see going into the FOMC, you were kind of flat. Pretty much everything was flat. Real estate was up, but emerging markets were down. They were not flat. Small cap stocks were down. They were not flat. The Qs were down. They were not flat, right? So we were kind of in risk. Commodities were down early. They were not flat. They rallied by the time we got to the FOMC. Gold was down, bonds were down, so bonds stayed down. Gold rallied with a weakness in the dollar. So the dollar initially jumped up but then fell post FOMC. So that pushed the commodities and gold up. Bonds fell as equities rallied. Emerging markets rallied too, but they had such a long ways to go. You can see it was the Qs that rallied by far the most. Small cap stocks also rallied. Real estate stayed strong. Developed markets finally rallied strongly. And then you can see everything else kind of corporate bonds, again, a riskier riskier bond market segment also did pretty well. Let's go take a look at like the market forecast chart here. Actually, let's look at this chart for what the dollar index is doing. So again, the dollar started off strong, got a long upper shadow, which we don't typically get, but still stayed above the 8-day moving average. That's a bearish candle though, and the top of that is, we're in bullish convergence mode on the dollar. We're not in bearish divergence yet because we haven't broken the 17-day, but that's definitely something to keep an eye on. The stochastics did cross above this moving average, so it may not happen tomorrow, but a bearish candle nonetheless that we want to pay close attention to. So the reverse of that would be gold, which got a bullish candle, long lower shadow. The problem with gold is it's also not above its 8-day moving average. You did get a good jump in volume here. You were in bearish convergence mode. You still are until you break above the 17. You notice if you break above the 17, you're probably going to be breaking above the 200 and the 52 and the point of control. So there's a lot of resistance for gold up above where we're at right now. So it's not going to be really easy for it to get going. TLT had been going parabolic on that breakout move. You got that Harami pattern to come back. It's flirting with that 17-day. It's flirting with a bearish divergence. It's only one day, so let's see if we follow through on that tomorrow. You got the point of control and the 30-day. So let's see if we break through that or not. When you get between moving averages, it doesn't always mean that you'll break through it. If you break through multiple moving averages like the 17 and the 30, then obviously you're not going to trade within the gap. But if you don't, then it's very likely you'll just trade into the gap and then get back above it. So same thing, if we break the 30 but not the 50, then we'll probably just trade in the gap there. So kind of like this, right? But if you break the 30 and the 50 together, like say they've been converging like this, then there's a good chance that you'll go through, you'll stay down. And same thing with the 200. And so that's how that works. So right now we're just between the 17 and the 30. So now we kind of need to see, are we going to do what we've already done and just, fill that gap and bounce back up? Or break through that, and then we'd have to look to see if we fill in the gap between the 30 and the 50. So we're definitely not bearish yet on bonds, not in the least bit. Let's also take a look at commodity prices because they've been struggling. Again, they had a good day today, but you see only getting to the 8-day moving average. We're back in the value area. We were above it. We're below the 50-day moving average. But we're trading just in the gap between the 50 and the 200, and the point of control is at the 200. So very strong support below us. We're definitely not, we're in bearish convergence mode with the MACD rising towards 0, but we're not above 17. So the 17-day exponential, so we're not in bullish divergence mode yet. Even with the positive MACD, we're still not to that point on commodity prices. Let's take a look at let's see why developed markets did so nicely today. You probably remember, but we'll take a look at these 12 grid. And again, now you see why the developed markets did so well. They were so far below moving averages. Of course, they have their biggest up days when they're that far below moving averages. That's how it works. So none of these look like they've changed their trends, not in the least bit. So we don't get wrapped up about one-day returns until they turn into new trends, right? Unless they kind of break out of some resistance. And obviously, it doesn't look like any of these look like they are reversing trends or breaking through any resistance levels. So that's why I'm still not too worked up about this bullish move today and thinking, oh, we're going to be bullish now going forward. If you take a look at the sectors moves, let's take at the sector comparison chart first. I remember it was the Qs and the diamonds that really rallied post FOMC meeting. So let's come over here to the 15th. And let's look at the 2-minute. So there we are. So going into it, you can see utilities were higher, real estate, healthcare, staples. It was risk off going into it. And down here at the bottom, you had energy, materials, and discretionary technology, communication services. By the end of the day, technology was the big winner. Not surprising, right? And by the end of the day, these cyclical areas did better, but still lagged the broad market. So, we talked about this is the Apple market, right? There was a funny tweet about You know, the people that were following Forrest Gump on his big long jogging marathon trip, and then he just stopped, and then they all stopped, and they wanted to see like where is he gonna go now, and he's like, I'm done, and they're like, what do you mean you're done? Like, you know, and so they were kind of following him because they were giving them purpose. Well, that's kind of like what Apple is right now. So, you know, Apple again kind of had hit a pause button on its march to the march to 3 trillion. We might have unhit that pause button again, only to get to that 3 trillion mark, where I've shown you before, especially in the tweets there, that when we hit the $1 trillion mark, we faltered. When we hit the $2 trillion mark, we faltered. And especially when we are parabolic going into those, like we are right now. I mean, even with this 2-day drop we had before today, Apple is still at parabolic levels, right? There's still a very high ADX. It's still rising. We're still well above 30. We're still well below 20 on the negative. So we're still in parabolic levels here. So I think we're still marching towards that 182.85 area, which is where the $3 trillion mark is, before we run out of gas on this. So Forrest changed directions, but then kept running. Now it started running again, and everybody's still following to see where Apple's going to go and when it's going to finish running. All right, now let's look at our trade idea of the day, and what I wanted to look at here was Eli Lilly. Eli Lilly had a really good breakout move today. Had some positive news regarding some of the drugs in its pipeline. You've got this little ascending triangle forming that we pretty much broke out of today. Near-term line getting up to the 90th percentile. The intermediate line turning sharply higher, 7%, 7% above its moving average. So, I mean, that's a strong, I mean, we're not dark green shading yet because we're not above 50 on the intermediate line, but it looks like we're headed there, right, with a very, very strong move. You had some bearish candles in the Hakinyashi that obviously now has turned bullish with the green arrow, positive PPO, positive differential. You got the lower shadow, so not quite totally bullish, but looking pretty good on that chart. If you look at the 3 green arrow charts here, you can see not only did we get 3 green arrows, but it was also accompanied with a spike in volume today. That's a bullish signal going all the way back to the InvestTools days there. And especially when you look at the 2-line version of this chart, you can see the 8-day and the 17-day crossing back up. You know, we got above the 17 and the 30, just like I was telling you before. And you get above 2 lines, you know, now you're not just going to fill in the gap. There's a good chance that we'll just break above. So considering how bullish that is, there's a good chance that we really get going with the 8 and the 17, getting back above the 30 and trending higher. So good breakout move. You can see from a directional movement index, very strong levels there above 40, well below 20. When you look at the RSI and the CCI, very strong levels here too, well above, you know, getting above 70, well above 200. I mean, this is a breakout move. When you look at the Bollinger Bands, here, let's look at the Keltner channel along with the Bollinger Bands. You can see that we got above both the upper band and the upper Keltner channel with green dots that had bearish momentum. So now, you know, you switch from bearish momentum to bullish momentum when you already have green dots. So that's a good sign for the stock. When that's a good breakout there. Obviously, you saw the volume. The trend strength indicator is not quite there yet because we were bearish, but obviously we're not bearish anymore. And well above the blue line, the green line you can see is crossing up above the blue line again after having crossed below it over here, well above the cloud now. The red line spiking through the price, so we are higher than we were 26 days ago. So very, very bullish patterns all across the board for Eli Lilly. So let's take a look at our trade, which is I decided to buy the at-the-money call option for January and then sell the first strike that's out of the money. So what that ends up doing is it gives me this long call vertical spread where I can make up to $540, which is more than my like normal bull put spread, but for a lot less risk. I normally put $1,000 at risk at 300. Now I'm only putting $400 at risk, 460 to get 540. So a little bit higher probability trade, because the hard part is I'm not really directionally bullish on the market as much as I am on the stock. So I'm willing to do a little bit more bullish than normal, but not too aggressively, and keep my risk really, you know, keep my risk half of what it normally is to get a little bit better return than what I normally get. And then again, if we do drop back down into that gap, then I can keep my loss to say $270, and then I can get a 2-to-1 reward to risk ratio by the time it's all said and done. Alright, that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's threads. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.